The financial markets moves in phases. This will be about market phases. Market drift is the long-term upward statistical tendency of an asset or index, created by growth, risk premia, and structural biases, not by the day-to-day mechanics of the market. Market drift is the linear story. This is the fairy tale, that price drifts upward over time, compounding is smooth, drawdowns are temporary, volatility is noise. The long-term trend dominates. This is the equivalent of saying, air goes in, pressure goes up, thrust comes out. It's not wrong. It's just incomplete. Drift is the macro shape. It is not the mechanism. The real market pattern is nonlinear, threshold-driven, state-shifting. Markets behave like a compressor operating near its limits. They oscillate, they jump states. They self-organize, they destabilize, they restabilize, they exhibit feedback loops. They respond to thresholds, not smooth gradients. Below is the real pattern, the nonlinear structure that sits underneath the illusion of drift. 1. Markets move in regimes, not lines. A linear thinker sees uptrend, downtrend. A nonlinear thinker sees expansion regime, contraction regime, volatility clustering, liquidity vacuum, mean reversion pocket, trend acceleration burst, shock response oscillation. These are state changes, not slope changes, just like a compressor. Stable flow, rotating stall, surge, restabilization. The system doesn't slow down, it switches modes. 2. Small inputs create disproportionate outputs. Linear thinking assumes small news to small move, big news to big move. Nonlinear reality. A tiny liquidity imbalance can trigger a cascade, a small order can sweep a thin book, a minor volatility uptick can trigger systematic deleveraging, a small shock can create a multi-day feedback loop. This is identical to a compressor where a tiny pressure mismatch creates a rotating stall cell, which becomes a full surge event. Small to large, local to global, micro to macro. 3. Markets are feedback systems, not independent events. Linear thinking treats events as isolated. Nonlinear structure is recursive. Price affects volatility. Volatility affects positioning. Positioning affects liquidity. Liquidity affects price. Price affects volatility again. This is the same loop as fan to low-pressure compressor, to high-pressure compressor, to combustor, to turbine, to shaft, to fan. You cannot isolate one variable. You cannot assume proportionality. You cannot assume independence. 4. Markets exhibit threshold behavior. Linear thinking assumes smooth transitions. Nonlinear systems jump from low vol to high vol, from balance book to liquidity vacuum, from trend to cascade, from accumulation to breakout, from stability to shock oscillation. These are phase transitions, not bigger candles. Exactly like a turbofan, from smooth flow to rotating stall, to surge, no warning, no gradient, just a threshold breach. 5. Markets self-organize into oscillations. Linear thinkers see randomness. Nonlinear thinkers see volatility cycles, liquidity pulses, trend pullback, trend sequences, mean reversion waves, shock response oscillations. These are limit cycles, the same pattern a compressor exhibits when it's near surge. Pressure builds, flow collapses, pressure dumps, flow reestablishes, then repeat. Markets do the same thing with price, liquidity, and volatility. The core insight. Market drift is the macro illusion. The nonlinear pattern is the micro mechanism. Drift is the story you tell at 30,000 feet, while nonlinearity is the physics happening inside the engine. Most investors stare at the drift, stare at the compressor map. That's the difference. I'm glad you enjoyed listening. We have a library of information on investing, and we want you to explore more of our perspectives. We look forward to seeing you follow us. Comment, like, and subscribe for more nonlinear personal market and investment insights.